Good afternoon, everybody, and welcome to today's Outlook with Jim Paulsen, our good friend from the Leuthold Group. I've already said thank you to him once, but I'll thank him again for getting roped into helping us figure out what the heck is happening with the markets right now. I'm Mark Salter. I'm the Executive Director for CFA Society Minnesota. I am going to take a couple of minutes first to do a couple of other thank yous. First of all, the firms you see on the screen, these are our annual sponsors. We like to thank them as often as we can for making it possible to do events like this, do professional learning throughout the year. They generously provide their time, talent, treasure, thought leadership, whatever you want to call it, to make it possible for us to continue to deliver high class, high quality professional learning, even in a pandemic. The other folks that we like to thank are our friends at CFA Institute. They generously have provided a Zoom meetings license for our society and many others around the world so that we can continue to deliver quality professional learning in the midst of a pandemic. Finally, on that virtual pandemic theme, we are going to try something different at the end of the meeting today. We are going to try some virtual networking. I was telling Jim a moment ago, some wicked smart graduates from St. Thomas recently put together a new platform that we're trying out that attempts to mimic in a virtual setting, the little pools of conversation that tend to develop when we're meeting in person. So if you can stick around for a few minutes afterwards, that would be great. I will have details on how to get to that platform toward the end of the session. You will have to close Zoom, close anything using your camera and microphone, and you can't get there by tablet or phone. It's a PC approach right now. So again, we'll have details when we get to that point in the meeting today. And if you can stick around, we hope you can take advantage of that. With that, I'm going to stop sharing my screen, if I can figure out how to do that. There we go. So that Jim can start sharing his. And while he's getting that going, I am simply going to remind everybody, we're going to use the chat function for Q&A today, rather than open up the microphone to, well, looks like we've got 90 people sitting on your every word today, Jim. So you've got quite an audience to wow today. And with that, I will get out of the way, mute my mic, and turn it over to you. And thank you again.
You bet. Thanks, Mark. And thanks so much for having me today, and also for everybody tuning in right at the lunch hour. Nonetheless, I'd be muting my cameras and wolfing down some food if I were you. I think what I got to say will go a little better with some food myself. But I'm going to, it's been a heck of a wild time. Welcome to my basement and my wife's quilt of the month here behind me. And I'm ready to get my shot in the arm as soon as they tell me I can. I'll tell you that. But it's been a heck of a year, and I'm going to focus in on economic growth a fair amount, because I think that's the biggest animal in the room here. And then talk a little bit about what that might mean for inflation and yields in the bond market. None of it's too good on that front. And then spend a fair amount of time in the back end on the stock market a little bit. The things that hit me the most just going into this today, one is that I think the stock market is going to have a positive year this year, although not spectacular necessarily. And I think that it's going to have at least one nasty correction at some point. Maybe it'll have multiple corrections, I don't know, but I think it's just going to be extremely difficult to call those. My best guess is that it will occur when we finally declare victory over COVID, which was when the herd gets vaccinated and there's a palatable relief and people are out roaming freely again. I think at that point, we probably we'll get some kind of nasty correction. But that said, I also think that that the best odds are that we are very early in a new economic expansion in a new bull market. We're not even 1 year. Well, actually, you could say we hit the 1 year anniversary. Now we haven't hit the 1 year anniversary of the bull market either, but we're not even 1 year into the bull market, nor 1 year into an economic recovery, which I think will probably be a multi-year recovery. And I think that's important to keep in mind going through probably a correction, or maybe more than one yet this year. So let's start in on economic growth. And I think that's the most fascinating part of the pandemic, is what it has done to economic growth. I'll come back to that in just a second. But I'm looking at pretty phenomenal growth this year. I may be all wet. I think the consensus estimate for 2021 real GDP is now up to about 4.5% for the year. And I'm looking at something like 8%. Heck, we might even surpass that. We'll have, it's possible. If we do around 8, we're going to have the fastest growth in 35 years of any calendar year since 1984. And if we get at all above 8, we will go back to growth rate we have not experienced in this country since the 1950s, and then only a brief handful of them. So we're talking about rarefied air in terms of economic growth and all the things that come with that, profitability and the like. But I think that is the key ingredient. I think there's still a great underappreciation of what this pandemic has done in terms of just supercharging economic growth, at least for this year and maybe longer. So I'll come back to. There are a number of reasons, and I'm going to just go through these briefly, but I think the biggest one is the lagged impact of past stimulus. Not enough is made of that it's not so much the current stimulus that's important as it is the stimulus that's about a 1 year lag starting to finally have impact. We're also getting additional stimulus as we speak. People are getting $600 checks, and they're going to get another bigger check here probably in March. It just doesn't stop. The same thing's going on all over the globe with global synchronized recovery going on. The pandemic synchronized everything. We have probably some pretty hefty pent-up demands. I know mine for restaurants is pent up. We've already seen some confidence return and the impact that has not only in the stock market, but also in the economy. I'm going to talk a little bit about a savings bomb in an economy with no inventories. And then I think the biggest thing that's been driving it is this last bullet point on the benefit from overreactions. So let's just go through this. I'm going to start with what this pandemic did to us. And this chart sort of brings this to light a little bit, I think, overall, in the sense that this pandemic put us on the biggest bust to boom cycle roller coaster ride ever in the post-war era. It took us, as you can see down here, to almost minus 10% year-on-year growth. By next summer, this summer, I should say, we're going to be plus 10 year-on-year. I think we're going to end up, in that plus 8 area as well. Oh, excuse me. And I think that ride has been really spectacular in the sense of busting us, moving us. This crisis has not only been unprecedented in terms of this chart, of the size of it, both on the downside and the upside, but also, more importantly, I think, it's all happened at warp speed. To take an economy from a depressionary bust to a wartime boom in 1 year is just unprecedented. And I think we're all having trouble keeping up with that. None of us, we're all caught off guard when it collapsed. And by the time we even started to catch up, it was over. And the markets were going another way, and so was the economy. And I think we've been behind this thing the whole way, and still are, in how strong this next year is going to be. So I think the biggest thing in the room is this roller coaster ride of a bust to boom cycle in the post-war era. I think the biggest thing that's really created the warp speed has been overreaction. And it's understandable. This is the most emotional crisis I believe we've ever had in at least the post-war era, in the sense that we've had all the normal recessionary emotion of losing your job, losing your life savings in the stock market, losing a business, all those things. But on top of that, we've had the health crisis as well. And put those together, there's just nothing like that in the past. And I think with that, the reaction to that from all the players, policy officials, companies, consumers, and investors was a really big overreaction. None of them were responding to this as a normal recession or crisis. They responded to it as a complete one-off situation, which demanded something entirely different than what normally is applied. So if you start with policy officials, we now have almost 27% money growth year on year. We got 15% deficit GDP ratio, which is probably going over 20 shortly. Both are all-time record highs in terms of the policy response we put in place. And I'm going to also talk about businesses and what they've done and what consumers and what they did to this. But let's start with this one right here, the policy response, because that's a big part of what's put us on this roller coaster. If I published this chart several months ago, but it looks back to really since 1915, actually, at what I put together, what I called the monetary and fiscal economic policy indicator. It's just combining monetary and fiscal policy into a single policy indicator. And what is amazing to me is, as of year end 2020, the average for the year, the amount of stimulus we provided was greater than any other situation in the history of the United States when you combine monetary and fiscal policy. That's the reaction that policy officials had to that. Currently, we are at 43% on this indicator. It was 47% not that long ago. And if you think about the amount of stimulus applied to the COVID war being 2 times greater than what we applied in the Great Recession or in World War I, and even greater than World War II, it's amazing what we've done. But the reality of this is the overreaction of the Fed and the Treasury to this crisis. It's only going to make growth better than it would have otherwise been. It's only going to make growth stronger than it otherwise been. Now, it might also aggravate inflation and other things, but overreaction here has led to even greater outlook than you normally would have coming out of a recession. Let's look at what businesses did. Businesses, in 1 month, essentially, when this hit, we suffered the biggest 1 month, or really, well, it all happened in 1 month. 1 month drop in real GDP, real output, the largest job loss ever, and the biggest inventory liquidation ever. That was the response. Businesses, as I say, didn't react to this as a recession. They reacted to it as trying to survive a pandemic and get to the other side. And their response was, let's cut everything, take our operation down to the minimum cost possible to run our company. And you can see that in what that's meant for earnings. This looks at S&P 500 trailing 4-quarter earnings. And what I want to point out here is although we've had S&P earnings come down over here, they have fallen by less than any other recession in the last 50 years. How could that be when we had the biggest drop in real GDP ever, the biggest job loss, biggest inventory liquidation, and we had the smallest decline in earnings? It's because companies reacted to survive. And in doing that, they put themselves in the most efficient operating position they could. And what that means is companies, I think, throughout the world, but particularly in the United States, are probably in a position of the greatest profit leverage ever, perhaps, because they're operating at minimum cost operations. And if you bring back demand on top of a corporate America operating at maximal efficiencies or maximal operating leverage, you're going to get a huge profit recovery. If we've already reached a new high, even before 7 quarters, in the 4th quarter, profits for the S&P companies was greater than what it was at the peak, and total economy profits, real GDP or GDP profits, actually went to a new high in the 3rd quarter. So we've had a smaller decline and a quicker recovery than ever before. Right now, current street estimates are for 170 for S&P earnings this year. I think it's going to end up being $200, which means that there's still a lot of room for people to reevaluate how they're looking at the stock market. And it's because of the overreaction that has occurred. I want to make a quick point with earnings as well of the impact of lag stimulus. This chart looks at real GDP here going back to 1960, and the blue line and the red dotted line is that monetary fiscal stimulus indicator, although it's pushed forward 4 quarters or 1 year. And you can see that historically policies lined up pretty well. When it happens today, and it isn't until about a year later that it really starts to impact real GDP growth. So we're just now entering the window where policy was first started to increase a year ago, and that policy is going to have more and more impact as we go through the year. And I think that's underestimated. It's not so much about what Biden's going to do now as it is what's already been dumped on the system. And the same thing's going to feed through to earnings as well. I just encourage you to look at this chart on your own. As I said, it's a synchronized recovery here that's going on. This just looks at the current consensus estimates for growth for 2021 off Bloomberg right now across the world. And the red dates below are the last time we saw a growth rate that strong. We're talking some really big changes here. You go to the Eurozone, it's going to be the biggest ever recorded if they just reach consensus, for example. So I'm just trying to make the case of how impressive the growth environment could actually be this year. If I look at the final thing, consumers and their reaction, I come back to this chart. Consumers not only have saved the vast majority of their stimulus, but they also pared down their credit card debt and other debts substantially. We had the biggest decline in credit card debt ever over a short period of time in this recession, which really hasn't been replaced yet. So they put themselves in tremendously better financial situation. But look at this 2 charts for a minute. We've got the potential of a savings bomb going off. We've got right now about a 15% savings rate, which is probably going to go back above 20% shortly with the March checks, which is so far above anything we've ever had historically. We've hardly ever had anything above 10% going all the way back to 1947. So we got this massive amounts of dry powder on the economic sidelines. And once this comes off, it's going to come off with absolutely no inventories in the economy at all. The level of inventories to the economy, this is showing up already. I mean, it's certainly noticeable during the pandemic. Anyone that's tried to buy a bicycle or weights or toilet paper or whatever, but it's showing up in bigger ways now. We have a massive global chip shortage, semiconductor chip shortage going on. We've had a shortage that continues on homes that are available for sale. We have a massive increasing shortage occurring in shipping crates for global activity. And if we think it's bad now, just wait till this thing hits. And all it's going to take to get savings to come off the sidelines is a shot in the arm. So I do think there's a lot of power as a result of these overreactions here that has really been responsible of probably shooting us back up to the moon here on the other end of that roller coaster. So I think growth is still being woefully underestimated by consensus. And whether that's good or bad is going to depend a little bit on if it's inflationary. I'll come to that 1 second. I want to make one final comment on growth about vaccines. So we know we're getting close. But this is a chart I did a while back that breaks the unemployment rate up between the 5 lowest major sectors in terms of earnings and the other top 8 earners. And the reason I did that distinction is basically what the pandemic did was it created a lot of unemployment among the lowest compensated socially interacted industries. And it bifurcated what happened. It didn't affect much of the rest of the economy. Much of the rest of the economy, this red dotted line, had a 1-month surge and then instantly returned to still a little elevated, but not much. Right now, 80% of unemployment sits in the blue line. okay? Only 20% sits in the red dotted line. And historically, they all moved up and down very closely, with the recessions treated them all the same way. This one's been very different. It's super bifurcated what happened. You're in a low compensated, socially interactive industry. You not only got hit harder, you haven't recovered as much. But here's the deal. We put a shot in the arm, this blue line could gap lower, because as soon as you put a shot in the arm, you're going to reopen. Businesses are closed, or even if they're already open at 30%, they're going to go back to 70 or 80 or 90 or 100. And that means those jobs are going to come back in a hurry. So rather than taking years, which it normally does, like here, to get our jobs back, this is going to happen much quicker. And that'll add to growth overall. And it'll also make people question why we provided so much stimulus. I'll skip over these growth out of these, but I just want to point them out. We've got this surge in household formations, and you can thank the millennials for this, finally deciding to form family units and buy homes. And we also got an interesting surge in new business formation that really has been going on much longer than the pandemic, which is a very encouraging sign. But I do want to spend just a second on this, a little more on this savings. This chart goes back to 1948. I'm just publishing this today, and it looks at total personal savings as a percent of GDP. And historically, this has averaged about 6.5%. And we've had a secular rise coming out of World War II to 1975. We had a secular decline in the last 30 years down to about 2005. And then since the 08 crisis, it's been coming back up, and now it's exploded. What is this? This chart to me is demand and waiting. It's basically sideline spending, if you will, just waiting to hit the economy. And it has had, as I'll show you here, an extraordinarily close relationship to what happens to nominal growth in the next 5 years and what happens to yields. And the blue line in both these charts, or excuse me, the red dotted line in both these charts is that same savings to nominal GDP ratio, which is now blown up to 14% in each case. I didn't take the scale all the way up there here. But what I laid on top of the left chart, this is the trailing 5-year growth in nominal GDP. And certainly when savings rise, about 5 years later, nominal GDP tends to accelerate. And the 30-year demise of nominal growth in this country that we've experienced can be in a lot of ways. It can maybe be applied to demographics and other issues, but there's also the fact that savings has been diminishing for 30 years. And now it started to improve, and so did nominal growth until the pandemic. And then we've got this explosion. I think we're going to have era, not just this year, but over the next several years, of US growth rates getting a lot better than what we've been used to over much of the last 30 years. And you can certainly see the implication that has for the bond market in a similar fashion. This same sideline demand with a 5-year lag has also affected the secular bond market bull, which is, I think, over. And we've already started in the other direction. Now, how high we go is going to depend on how inflationary all this is. But I think this savings and what the pandemic did to it is a huge, important variable for the character of the future economic growth and financial markets that I don't think is fully appreciated. Okay, let's move on to inflation. And as you might have read from I think this is the biggest risk. I don't think this is a damaging risk this year. Yes, yields are going up like there's no tomorrow. We got a 135 10-year right before I came on here as we speak. And there will be an impact that if it goes up too fast, too long on stocks. But we're getting this initial year boom here in 2021 from all-time record low bond yields and extremely low inflation compared to historic norms. I think you couldn't ask for a better time to get a growth boom in an economy that has a global stagnation player mindset, unprecedented low yields and very low inflation. I think the growth is going to win this year. Inflation is going to come up. I fully anticipate that. We're going to have 4% CPI inflation year on year at some point this year, probably in the middle of the year. I think core rates will come up. We're probably going to have core inflation above 2% going into 2021. But both of those, the 4% is temporary a little bit. The above core at 2 to 2.5 is not, but it's certainly not a threatening inflation rate. Yields, I think, are going to continue to rise, and it's going to create a bloody bond market this year. I think we'll reach 2% this year, maybe even a little above before the year is out on the 10-year yield, putting immense pressure on the Fed to give up the ease, or maybe even be forced to start thinking about increasing the funds rate. Although I would say this, a normal sloped yield curve in recoveries going back is typically peaked out around 300 basis points between 10s and cash. And that would mean that this bond yield could rise all the way to 3%, and the Fed wouldn't be out of the ballpark in terms of a 300 basis point curve steepening before they react. And that might well be the case. It gets to 3% before we raise funds, which probably won't occur until next year. But here, this chart, I'll just point out, it's just amazing to me of the amount of record-setting stimulus we have provided in this pandemic when the unemployment rate came back down faster than ever before, and it's no different than it's been in 3 of the last 4 recessions. And the amount of stimulus up here that we're providing today compared to what we provided back then isn't even close. I really think policy officials, like other players, have overreacted to this, and we don't need more stimulus. Yes, will it help certain people? Absolutely, that are still trying to hang on. But it's very out of character to be doing what we're doing. There's a lot of pain and suffering back here where we never provided the type of stimulus that we're providing today. My son's a great example of this stimulus part of this year. He's had a web retail sales, e-commerce job. He's been employed the whole time, but he got the initial $1,200 check. He now got the $600 check. He's going to get the $1,400 check. And because he was e-commerce, his job, web-based sales went through the roof, and he got bonuses on top of it most year. And then his company filed for pandemic relief for risk of their employees coming to work every day. And he got payments for that. It's just an amazing, I think, over-stimulus kill. That's not making political statements, just looking at this economically past to present situation. And certainly the risk we have, and the biggest risk of all, is overheat as we go forward. This is looking at the 10-year treasury yield in the blue and the embedded 10-year tips inflation expectation in the red. These are woefully out of date. This thing's gone up to 2.3% this morning. This thing's gone up to 1.35% this morning. So they're definitely moving. And as you can see, normally yields are above embedded inflation expectation. There is a lot of upside room for yields to move. I think we're going to see 2% this year and probably get back towards the 3% in the not too distant future. I'll come back for what that means stock, but here's what it does mean for bonds. There are still far too many portfolios owning far too many bonds. This had bondholders win. This did no damage to bondholders, even though stocks was soaring. This is starting to hurt them. And one of the things that we could see from this as rates keep going up is people actually put more in stocks as they finally decide they have too much in the bond market and start reallocating even more towards the stock market. That is, rising rates could force more assets towards stocks as the pain goes up. But this could be one of the bloodiest bond markets we've seen, at least since 1970s, and maybe even worse than that when you're thinking about coming from such low rates with very long durations on the bonds they hold. So overheat is really the question overall. Here's my final take on this overheat question a little bit. I'm out. I don't think it's an issue this year. It could start to be an issue big time in 2022, 2023, 2024. But to have the US and maybe the world after a 30-year demise in growth turning towards a secular upturn on the back of immense unspent savings is should cause a lot of elation in terms of heading to a period. It's like coming out of the late 40s and heading into the 50s and 60s is one possibility. And the question is, are we really in the early 50s or are we in the late 60s with this happening? I'm on the fence about whether we're going to abort this recovery early because of overheat. I lean that we won't. That's my better odds case. But I'm wary of it, and we'll get more information as we get down the road. And I could certainly in 2022 get very concerned that we're going to end the recovery in the bull market prematurely because we're going to have to tighten so aggressively to shut things down. But as much as policy officials are trying to overheat conditions and preemptively end what could be a wonderful prolonged recovery, there are a lot of offsetting forces to that. And I think it's good to remember those. We are being led by a deflationary sector called technology, where unlike the automobile industry that led us in the 50s and 60s, here the leading sector, sticker prices go down every year, not up. Huge deflationary force that's continuing to grow as we speak. Developed world economies and the leading emerging world economy, China, has absolutely lousy demographic trends, which are going to persist, and that's a huge deflationary force. Global competition in the world is stronger than it's ever been in the history of the United States economy. It was probably going to get even more so with Biden opening things up again. The recent outperformance of new era sectors of tech, of growth over value. Now, I don't have that chart in here, but I wrote about it. There's been a really good relationship between periods where growth beats value, and then over the next 3 years, productivity does a lot better. So I'm also anticipating that productivity is going to pick up here just at a time when we need it. Current unemployment rates of 6.3% for the U3 and 11.1 for the U6, both suggest both are way above norms and would have to come down a lot more before they really create sort of untractable inflation pressures. And the fact that labor force participation rate is down also suggests there's even greater elasticity in the labor market than what's suggested by unemployment rates. And finally, the US output gap is at 3% right now. It's much improved from where it was just a few months ago, but it's still lower than 86% of the time since 1948. So we've got a lot of things to make up. That is, we could have strong growth against unemployment, if you will, resources for a period before we just have runaway inflation. I think we're going to get a spike in inflation and then a cool off where we have higher average inflation, but it's not runaway inflation. That's my guess, but I'm not totally sold on it. As I say, it wouldn't be shocked if we have to change that view to overheat and preemptive easing. That is, to me, again, the biggest risk. Let's turn then to the stock market, and we'll finish up here. The biggest thing in my mind is just this: simply growth. And when this chart goes back to 1948, and it looked at all the quarterly periods at the average and how the stock market did in each quarter, given how much real GDP changed from the year ago till now. For example, if we go from minus 10% year on year last summer to plus 10% year on year this summer, that's a 20% change in real GDP. That would put you in the highest quintile of GDP changes. How does stock market do? Fantastic. That's what I'm saying. Just simply don't forget, whenever you take the mindset of investors from collapse to boom in such a short order, generally it drives the stock markets higher. And actually, you still do pretty good, even if it's in these middle kind of quintiles. You really got to get down in here before when stocks have not done that well. So just to keep it simple, if somebody says we're going to have colossal growth from an environment of unprecedented low rates and relatively low inflation and a deflationary stagnation sort of mindset, boy, buy stocks. That's what I'd say overall. Doesn't mean it has to work out that way, but we're still up maybe 15-16% from where we were pre-pandemic. I know we're up 75% off the lows, but a lot of that was just catch up overall. So I think growth is, again, the big elephant in the room. Here's that lagged impact on earnings I talked about. This is actually S&P 500 earnings, the blue line, year-on-year growth, and the red dotted line is that monetary fiscal indicator pushed forward 1 year. And you can see, again, it's pretty close with not straight on, but with a 1 year lag. And so we're just getting into the period of time where this initial pickup in stimulus last year is going to really start to bring higher earnings. And again, we had about $150 earnings pre-pandemic. I think by the end of this year will be 200, and that's roughly a 1/3 increase, or 15% per annum over that whole period of time. Not dramatic. It's going to be a big surge off those lows that we had last year. But if we're going to do $200 earnings by the end of the year, suddenly this extremely high multiple market, if the market ends the year at 4,000, I think it might be 4,100 is my guess. But if it ends the year at 4,000 on S&P, that's a 20 multiple, which is it's not cheap, but it's not exactly out of this world expensive either. And I can see that if the market's thinking 170 or something, but I think we're going to come in more. Then we've got a lot of divot repair to work on here yet. And the chart on the right here is the output gap. It's back to -3%, but you can see where we were at one point and the damage we did. And we certainly did a lot of damage in the job market. And we are back to 6.3 on this chart. We have had 3 recessions now in our history that had +10, that created divots such that there was a 10% or more divot in the jobs market. This has certainly been one of them. And what's the impact when you have big divots on how the bull market shapes up in the future? So this was 82, the 2009 financial crisis, and the current one. And if I look at the next page, I just go back of what the average annualized future 1 month S&P returns were by unemployment rates. And there's no doubt about it, when you're in the highest unemployment rates, the future 1 month returns are by far the best. And we're still sitting somewhere between here, between these two situations, more over here right now at a 6.3% unemployment rate, where future returns. And the reason they're good is because there's so much to improve. If you can we've already brought this down to here, if we can bring it back down to here in the next few years, every time it does that, incomes go up, spending goes up, profitability goes up, all of which tends to be good for the stock market. So while a big divot on Main is horrible on Main Street, no doubt about that, it typically is good on Wall. And indeed, if you're waiting to when the economy repairs, that'll be when you want to sell. It's not a surprise at all that the 2 stock markets, that this bull market, the green line in this bull market, which now is up to about here, is where we are now. Actually, right about here, I guess, right about in there. If I update this chart, the 2 bull markets it's most closely associated with are 1982 and 2009. That is, the reason is because they both had the big divots. This is a big divot bull. And it's tracing these markets out very closely so far. Yes, we could have a pause this year. I actually think my best guess, and this is just guess, is we go up to something like 4,400 this year, come back to 3,900 or something, and end the year at 4,100. I think it's going to be that kind of a nasty correction at some point, kind of reflecting what happens in the second year of big divot bulls. But here's the key: in both 2009 and 1982, after this adjustment year, both of these markets went considerably higher for a long number of more years. And I still think we're somewhat in that ballpark with this one because of the divot. I want to talk a little bit about investor sentiment. There's a lot of concerns too optimistic. I agree it's really optimistic, or it's gotten much more optimistic. I'm just not sure if our indicators of sentiment work as well in an economy that's changing this rapidly from depressionary bust to wartime boom. I'm not sure these sentiment indicators keep up with it. Just an example, the blue line in this chart was a combo package of two prominent investment sentiment indicators, the US call put ratio and the AAI bull list bear indicator. And you can see here when I did this, they got pretty darn high, suggesting stock market was too optimistic. But what I laid on top of there was the US economic surprise index. And it makes sense when US economic surprises are doing better, sentiment gets better. But look at where economic surprises got to. Maybe sentiment needs to get up here in a world economy that's changing this much this fast. I also still see a lot of things that tell me that there may be short-term positive sentiment, but there's still a lot of cautiousness in my book. This is a ratio of high beta to low volatility, the S&P high beta, the S&P low volatility total return index. It really got low in the pandemic, no doubt about it. And indeed, it collapsed during the 2009 crisis and never really recovered. What we've done so far off last year's lows have gone from extremely pessimistic to pessimism in my book. We're nowhere close to like average sentiment, and we're certainly nothing like we were in the .com. If we truly had attitudes like .com today, people would be buying a lot more of these relatively cheap high beta to defensive investments, but they're not. There's also other things that show up. The price of gold to overall commodity prices today remains close to a 50-year high. This was a 50-year high here going back all the way to 1970. We're down to about here right now. It's come off, but it's still extraordinarily high. People still are piling into gold relative to other commodity prices, which is a reflection of the bearishness which exists. Yes, in this middle chart, in recent weeks, there's been an uptick in weekly new cash flows into stock, funds, and ETFs. But boy, we have a long ways to go before you could call this bullish. Too bullish. And indeed, I think stock or bond, the red dot line is going to come down, and this is going to go up. That could be another strong force yet for stocks overall, and a negative force for bonds. There's just too many people in these and not enough in these in my book. I'm going to come back to VIX in just a second. One last one I'll point out is right here, U.S. high leverage stock price index to low leverage stock price index. That does not look like a bull market. This is all we got so far. There's still a lot of defensiveness in that chart. And then the last one, there's been a lot of concern lately. Almost every day, the media is full of this market's ridiculous. It's a mania. It's a bubble waiting to collapse. I recently did a Google trend search for the word stock market bubble, and this is the chart I get. I really think the bigger bubble at this point might be the worry of a bubble as opposed to the actual bubble itself. And why is the VIX index continuing to stay up here as though we just got done with a bear market, as opposed to just been in a big rise in the stock market? If we're really that optimistic, you think the VIX would be down in this range. So I don't know. I just bring some of that up. My take on where sentiment is at the end of the day comes down to this. And that is that if you think we're too giddy today, where do you think we're going to be on VC day, victory over COVID day? When we've all got a shot in the arm, let's say in the fall, and we get out, roam freely, go to restaurants and entertainment facilities and ball games again, interact. And because of that, all these industries that are closed reopen. And because of that, jobs are regained and incomes and employment are. How much giddier do you think we're going to feel as a country on VC day than we do now? I think, in my mind, it's got to be more. And I think that runs not just through the economy, but also the stock market. Wrapping around out of time, just cover a couple more things and I'll have to just quit. A little bit about valuation. I agree valuations are high, but the fact on valuations is they've been high for 30 years. The Cape Shiller P multiple has been above its old range from 1870 through the till 1990. It's been above that old range almost 80% of the time since 1990. So something different is happening. I'd also point out that the trailing P mul in the S&P 500, although very high, it was also very high at the start in 92, 2002, and 2009 because earnings in every case collapsed. And I think it's a very similar pattern here. I'm kind of thinking we're going to continue to have a bull market go up like we did back here. And as we do, it gets cheaper. And I said 20 times earnings could very well be where we start next year at this time, if earnings come in up at that $200 level overall. I'm going to have to skip over this. I would just point out, I wrote a piece recently thinking about all the favorables on this market. And, you know, the Greenspan put started this idea of the Fed put. And when Greenspan started, it was the idea that, you know, maybe in times of crisis, you get a little more aggressive with monetary policy. And people thought, well, that's like a put under the stock market and the economy. I agree. Well, we have the biggest policy put ever in our history. Nothing like it, as I showed you earlier. Monetary and fiscal together putting. We have a unique put in the vaccine put. We have one of the fastest rising and probably more persistent EPS revival puts of any. If I go back to here, this liftoff is even faster than the 09, and it's certainly faster than the rounded bottoms of the previous two recessions. And I think it's got more to go. A massive EPS put. We've got no inventory put. We've got that massive savings put. We got a bubble watch put. We got a dry powder with too much in bond funds and not enough in stock funds. And we've got a low yield put, which I'll just hit on real quick. I went back to, you know, yields are rising. How fast are they going to hurt us in terms of the stock market? And I went back and looked since 1900. And I look at monthly data and I divided the universe up for all months when the 10-year yield was below 3% and for all months when the 10-year yield was above 3%. What did rising yields do to the stock market? Well, when yields are above 3%, when all the months when yields rose, the stock market on average went down at a minus 0.2% annualized pace. It was almost flat. When yields rose, the stock market just did not go up. But when yields declined, stocks did really well, 12% per annum. That was the old model if yields were above 3%. But we've been below 3% only about 1/4 of the time since 1900. But when we have, the relationship to yields is night and day different. When you have falling yields, stocks don't do that well, not near as well as they used to do. But when you have rising yields, they do spectacular. And I think the difference is when you've been above 3%, normally the stock market's worried about overheat and inflation. They're not worried about growth. So higher yields connote PE contraction, Fed tightening, inflation pressures. That's not the connotation here. When you're below 3%, when you have negative yields in the world, higher rates simply connote that the economy's getting a little better. And I think up until about 3%, it actually improves confidence in the future rather than reduces it. And that's kind of what we're seeing. Rates have gone from 50 basis points to 130, and stocks have gone a lot higher. I think that may continue at least up to 2.25-ish, maybe even to 3% before they really bite in a big way to the stock market. I'm not saying we couldn't have a correction before then, but ender, I think we're a ways off because of this special relationship. Just point out, you look at these charts yourself. I think you want to have overweight in broader market plays. To me, those are cyclicals. They're value more than growth, and they're small caps. they tend to do the best over here when you go to boom conditions. Those broader market plays like heat, and I'd also put the international markets in there as well. But I would not exit technology or new era. I think, look at these charts yourself. I think new era is going to underperform in this next year, but I don't think it's going to crack or die. I think it's going to participate, and it does wonderful things on days when the market pulls back. It tends to hold up. So it'll offset some of your great cyclicality you get when you add deep cyclicals, when you add value stocks, when you add small caps, when you add international markets. Higher vol plays, a good offset to that is new era growth, even if you don't think it's going to outperform over the whole period. I would be careful with defensive investments yet, even though you're tempted to overall pick away at them. I think that growth going up here, up into this range, is going to be hard for defensives to do well. How about the risk? We still have risk in COVID if it mutates to something we can't extinguish. I would definitely expect a correction or corrections this year. We could have a temper tantrum with the bond market, and our biggest risk long term is fallout pressure-wise from overuse and abuse of policies. I'd leave these with things you might consider, things that I've used in our global tactical asset allocation fund I'm involved with. With that, I'll open it up to questions or anything you want to, any place you want to go, Mark.
And yeah, we have time for questions here. Just a reminder, folks, the easiest way to do this with more than 100 people on the call is going to be to type your question in the chat window. So if you've got a question or two for Jim, go ahead and start typing now, and we'll see what comes through. While we're waiting for people to do that, just a quick reminder about the attempt to, we're going to attempt to do some virtual networking once we're done with questions. So if you're interested in doing that, please stick around for a couple of minutes and I will give you the instructions on how to get that done. So, not seeing any questions coming. Here we go. All right. Well, it's a compliment first. Great presentation. Thank you. Will a replay be available? Jim, correct me if I'm wrong. You said you thought it would be okay to record and provide a replay, correct?
Yeah, that's fine, Mark. That would be fine. I don't think I used any dirty language or anything. We can't republish.
All right, we will give a listen, and maybe if there is anything like that, we'll cut it out. Anyway. Peter Schmitz, good to hear from you. Can commodities keep going, Jim? Copper is a double from 1 year ago.
Yeah, I understand your feelings on that, Peter. I own some commodities in our GAP portfolio, industrial commodity ETF, the BCI ETF, and it doesn't have quite as much energy weighting as some of the others, but it's more at general broad commodities, but more industrial related. I'm sitting with that. I almost think I prefer stocks, but as much as they've already gone up with Europe, but I think they're going to continue to do well over the next few years. And the big wild card there, and the reason I kind of own it, is the DXY is sitting around 90 or the 88 area, is sitting on a major technical support. If it breaks it, it really probably very quickly moves below 80. And I think that could happen. Maybe not this year, but the next couple of years. And if it does, then I think you'll be glad you own some commodities. So I think some still makes some sense.
All right. New question. Oh, now they're coming in. When do you think rising tax rates will become a risk for equities? Asks Mike Bailey.
I think my guess is 2022. We're going to see that. It'll be very interesting to see where we're at that time. I'm not sure it'll come in much before that. I think there'll be be difficult to get a lot done. They have a lot more on their plate right now. But the thing is, to me, I wouldn't worry too much about. I think we always worry a little too much about politics. I can do that too. I think there's bigger things in the room that probably went out, and we're talking about the growth rate. You know, if they are raising tax rates this year in an economy doing 8% growth, I'm not sure we're going to notice it too much. But I do think it'll become, if it is an issue, become an issue probably in 2022.
Okay, fair enough. New question from G. Plastry. What do you think about the dollar, besides it being green and things?
Yeah, as I said earlier on commodity markets, I guess my best guess is the dollar goes lower, and what we're seeing now, I think, is the spread between U.S. growth and global growth is going to diminish. Generally, almost always does in periods where there's a global synchronized pickup. This happened even in small ways over the 2009, 2000 current recovery up till 2020, where when there were synchronized pickups, the growth spread would diminish, as would the yield spread, and as a result, the dollar would weaken. And I think we're going to see that in a bigger way. I mean, think about the yield spreads right now. Take a gander when you get off this call at where global yields are. A lot of those global yields are now turning positive again after being negative. Even in the Eurozone, they're getting very close to that 10-year breaking back to positive. And they're diminishing their spread relative to the U.S. So the yield spread's diminishing. The growth spread, I think, is going to diminish. And I think that's going to continue to put downward pressure on the U.S. dollar. Also, the U.S. is the least beneficiary from inflation. All the rest of the world is a much bigger beneficiary of that because they have more industrial commodity-based companies than we do. So I do suspect the dollar goes lower. You also want to own some international stocks. Yeah.
Excellent, excellent. All right, so what sectors do you think would outperform this year? And what about large versus small and emerging markets versus US?
Yeah, I did on this page 36 here, some of the things I would still own. I'll just throw them out real quick. I would still own some micro caps and high beta. They've both done really well, but I would at least own them till VC day because I think sentiment's going to get even stronger. And as bond pressure builds, it's going to force people in stocks. I think the micro caps and high beta are going to continue to benefit from that. They're also huge beneficiaries at the most extremely good growth rates in the economy. Come back to Bitcoin. I would definitely own emerging markets. I like that better than international markets overall. And I would own some, but I'd own it ex-China. And if I could explain why if you want to get into that. But I think China is going to be a loser post-pandemic here. And new leadership is going to start to emerge in the emerging world. They will no longer be the poster child for that. But I think emerging world does really well, and I'd certainly have an overweight there. I've never been good at shorting bonds, but I think a great way to play that right now is to buy financials or buy banks, which just are 100% correlation with what yields are. That won't always keep up, but I think it keeps up the rest of this year. And it's a great way to play against that bond pain going on. I do own some home builders. They've done okay. They've paused now in the last several months. I think they're going to continue to do well next few years, primarily because this is more of a secular trend with millennials, Jenners taking over the biggest part of the population and forming households. I'd certainly buy international equities too. I particularly like Aussie and the Eurozone of the two developed markets, I think that are most interesting to me. But another way to do that, and we've done that, is just buying some of the materials and industrial sectors. And I think a good way to do it is to buy equal weighted global materials and industrial sectors or ex-US to participate in the synchronization of growth and better growth probably abroad. I haven't yet bought a COVID reopening play, like a deep airline or I didn't do energy. But I think it makes some sense as we reopen to maybe have a little bit of exposure there. And then, as I say, I would still own some new era tech, whether you do that directly. I've had really good experience with small tech. And we certainly not listed on here have a big overweight in small caps. Some of that's in micro, some of it's in smalls. But I also would look at continuing to own a little bit of technology as well.
All right. A follow-up on the bond question. Sort of, how does credit and high yield, how do they perform under your scenarios? And there's a question in here. I'm not sure I'm getting the thrust of it, but the question is a delayed fate as government bonds?
You know, to tell you the truth, I certainly don't want much at all, if any, high quality bonds right now. And in fact, you know, in the GAT, it's a balanced GAT. So we're 80% equities, 20% other. And I'm trying to get as far away as I can from the bond market with the other. I think we hold 20% bonds, even if we don't like them, just because that's what you're supposed to do. But I just don't think in a world where yields are facing what this pandemic has done, putting us on this big upside roller coaster, they make any sense at all. I just don't think they do. So I would, particularly high quality bonds, and that'd be munis as well, I'd really look to lessen that. I think the one area you could still play are some of the credit areas. And I'd still be tempted for down some more of the junkier areas in that. I do think that a risk of cascading bad debts is passing if it's not passed. I do have a chart in here. You can look back in the packet. You'll find a chart overlaying spreads on top of Bloomberg's bankruptcy risk. And it's not so much that I think there's going to be a lot more tightening of those spreads as I think they might stay tight over the next couple of years. And so you're still going to come out better there than you will high quality alternatives. But I'd look at some alternatives, and you know, brought up already commodities. You may also look at some other alternatives if you got access to privates or you got access to venture or something. I think some of that other stuff might make a little sense, or at least look at emerging market debts or something, because I just think the high quality U.S. debt market or high quality developed debt market just doesn't make a lot of sense. We may reprice it in the next few years and then we can go back to it.
All right, and as usual, you have stimulated lots of conversation and more questions than we can possibly get to. I'm seeing questions about longer term view on Bitcoin and cryptocurrency. I see a couple of people wanting to know what the heck Jeremy Grantham is overlooking to arrive at his bearish forecast. What's he focusing on? We've got a question about zombie companies due to low rates and maybe following Japan down a deflationary path, and more on QE. And I don't think we've got enough time left in the day to get to all of those things. So unless you have one of those you want to attack in 30 seconds, Jim.
Okay.
Okay.
Well, let me just say, not so much Jerry Grantham, but you know, I get the bear case, and I think there's good reason. You can make a very cogent argument about why to be bearish. I mean, certainly sentiment indicators are up across the board. We certainly have all kinds of minor examples of Reddit and IPO SPACs pricing suggesting potential excessive optimism. You know, there could be still something going on with COVID. I think the biggest reason for bearishness, though, which is legitimate, is the excessive valuations that we have today relative to their historic norms. Personally, I think we're in a different valuation environment, which is always a dangerous thing to say. I think we've been in one for 30 years with a lower rate environment as well as higher valuations and a more tech-driven world. And I think it may persist, but I get the case. And if we collapse tomorrow, it's going to be easy to point to excessive valuations as a primary. So no one knows. I don't know. So I certainly understand where the bears are coming from.
And on that quasi-positive note, I think we will we'll call a halt for today's formal presentation. Again, folks, if anybody wants to stick around and chat about this, we're going to give you instructions in just a second on how to navigate your way over to a different platform. But I will end officially by saying, Jim, thank you again. It's always it's always fun to see what's cooking in your brain and the things that you're paying attention to. And I know the 100+ folks on the webinar today feel the same way. So
Thanks so much again, Mark, for having me. I appreciate it very much. Appreciate everybody tuning in.
All right, sounds good.